Hi there. Welcome back to this week's episode of Deb Talks here with Lupe.
Yeah.
And
Hello.
this week, and I'm just going to forewarn somebody right now. We have got, I'm dog sitting my grand dog. So if you see a beautiful yellow lab come through the picture, you know what? It's just Hank. And you can just say hello to Hank.
And he might require us to toss a toy around to
Yeah.
entertain him, so we might be doing that as well.
So,
So, yeah,
There we are.
there we are.
Yeah. But this week we wanted to touch bases. We're on a couple loan types that might be able to help you get into a home.
Yeah.
And the reason is because we are asked quite a bit. We don't want to dive too deep into each individual loan type. We can go through that in different, and in future talks.
Or if one of these options resonates with you and you wish to just call us, and we can definitely sit down with you and go over those options.
Right.
Mhm.
Because I mean, it's no secret. Interest rates are still a little bit higher than what people like. They're coming down, obviously.
Yeah.
They'll never get to what they were because that was an anomaly during the COVID.
Yeah.
But they're going to start to be on their way down. So
Yeah.
what
They're
are some
going down,
different,
and home prices are still staying.
still staying, yes, and they're going to continue just because of that shortage. So we're asked different ideas on how to help our buyers get into a home.
Mhm. Yeah, we definitely, there's a lot of people that are, give us a call on a daily basis, and we get asked, what is the way to do it without me having to go through my savings? Or what if I don't have savings but I want to
Right.
get into a home? I'm tired, they keep raising my rent. And I hear that all the time.
Right. So on the first program,
Mhm.
then let's talk about loans that have down payment and or closing cost assistance.
Okay.
Okay, so that can help people obviously get into that. But what we want to do is dive deeper into what those programs look like.
Mhm.
I want to make sure you're educated and you understand what you're getting into when we do those loan types, because I think
Yeah.
that is extremely important.
Yes, it's not just because we hear that, and I'm sure that I feel that the term gets tossed around loosely, first time home buyer. You hear that term, but I feel that it does get tossed around too loosely. Don't you agree?
I would agree with that. I mean, there are some first-time homebuyer programs, but the reality in the state of Idaho, the best one no longer exists.
Yes.
And that was done through the Idaho Housing Bond Department. Great programs. Okay, I'm not telling you they're not great, but that one was taken away at the end of last year.
Yeah.
I haven't seen anything saying that that's going to come back. What that did for clients was that actually gave them a much cheaper interest rate.
Yep.
If you were truly the first time home buyer and fit into that parameter. Great program.
Great program.
This down payment is the down payment assistance program
Mhm.
that's still out there, and there's more than one, but they all work the same way.
Yes.
Okay.
Mhm.
That actually, you do not have to be a first time home buyer to qualify for those loans.
Nope. No.
Okay.
So on these, because I know that some people have asked, okay, I just sold my house a few months ago, or I sold my house a year ago or 2 years ago. Would those people then qualify for these first time home buyer loan programs?
Well, we couldn't put them in the first time. There's caveats to that, but the reality of it is, they could more than likely qualify for the down payment and closing cost assistance programs,
Okay,
which are not fully in conjunction with the first time home buyer program.
okay,
Okay.
okay.
So they could qualify that. Those are income limit programs.
Mhm.
Um,
And what is the income limit then? To be
so on the one that truly is the best one in Idaho, that has best interest rates, has best everything, there is $150,000 income limit. Okay, unless you're in two different, Blaine County and it's the county vicar. It's up by the border of Jackson,
Victor
Victor County.
Mhm.
Those are two higher end, so you could make more if you were looking at that and wanting to get into the down payment and or closing cost assistance programs.
Okay, so
Okay,
there's a chart, and then there's different areas where,
Two different areas
Okay,
that you
two
can make
different
more than that.
okay.
Yes, okay. But what I want our client, our audience to understand is how they work,
Yes.
okay?
Mhm.
They are good programs, but how they work is pretty simple. And I'm gonna give the example on a purchase price of 250,000.
Mhm.
Okay, that might sound a little low, but that's where I've got
That's
the
our
numbers.
example.
That's our examples, okay? So let's say a borrower, like the scenario that you gave,
Mhm.
sold their house before, and maybe they do have some money, okay? So if they're looking at putting minimal down and you're doing, say, an FHA loan, we could do the same thing with conventional financing, but 250,000 and you're needing, or you have 3.5% down, which is what is required for an FHA loan.
Mhm.
Okay, and I am going to do my cheat sheets here.
Mhm.
So the down payment on that is $8,750.
Okay.
Okay, so that's your down payment requirement.
Okay.
Um, then there's, remember a couple episodes back, we talked about transparency. There's always
Yes.
closing costs and prepaid still involved to get into your new home.
Okay. Yep. Yeah.
So on this example, let's say the closing costs and prepaids are roughly about $6,300.
Okay. So
Okay.
that's different than my down payment, my
Right.
3.5%.
Right.
Yep. Mhm.
Okay,
Okay.
but you add both those things together, that's about $15,000
Wow.
that's
Okay.
needed to get into that home,
Okay.
okay?
Okay. And if I don't have that,
Or even if you have it, but you choose.
if I choose not to use it, I want to
Right.
keep it for
Right.
emergency or whatever. Okay.
Here's an example of what that would look like. If you had your own funds needed to close of that 15,000, let's say on your FHA rate, I am given an example. Okay, I'm not quoting out a rate today because I need much more information from you to quote a rate. But
Yes.
let's say that rate may be 6.375 today to
Okay.
get into that loan.
Okay.
Okay? If you need the down payment and closing cost assistance, it's instead of that 6.375, your rate on your first mortgage goes up to 7%. Okay, this is an example, but that's where that might come in play at. So your rate on your first mortgage is going to be higher than if you used your own funds.
Mhm.
That's okay. We're gonna talk to you about it. We're gonna show you those payments, if that's good with you. How the down payment assistance and closing cost assistance works, however, and there's my grand dog, is you get, you need that, and that's 15,100.
Okay.
Okay, so you can get that money.
Okay.
That money's not free.
Okay. Yes. So
There's a
there's
loan.
money that I can use that's available to help me, so I don't have to use my own money, but it comes with, there's a catch.
There's
There's
just, it's a catch, understanding what it means.
correct.
Okay,
That's what I mean.
so that 15,100 then comes to you in the form of another mortgage, a loan against that property. That interest rate is going to be 2 points higher than your rate at 7%, if that's what the rate was at that time, right?
Right.
So then your 15,100 has an interest rate of 9%, termed over 15 years.
Because my first loan rate is at 7,
Right.
but the second one will be +2, so
It's
9. We'll be at 9.
On the example we're using, that's a 9.
Okay.
Termed over 15 years.
Okay.
So you've got your payment on your first mortgage and you've got your payment on your down payment assistance and closing cost assistance loan.
Okay.
Okay, whether you use the Idaho housing one, which is fabulous, there
Great program.
in the state of Idaho, there isn't a better down payment assistance type of loan. I can tell you that. But we work up the numbers to show you that. Okay, so we're not
Yes.
here just to say, that's it, that's all we got.
And
Because there's other programs, but they work the exact same way.
okay. So let's say I want to use this down payment assistance second loan. I'm going to call it the second loan at the 9%. And I'm given 15 years, but after a year or two or whatever, I have some extra money and I don't want that. Can I pay it off without any penalties?
Absolutely. You can pay that off at any time without any penalties. And in fact, I know what we do is we do encourage our borrowers, if you're going to pay extra on your mortgage, pay it to that one first,
Okay.
okay? And get that one knocked out quicker.
Okay.
Because here's the other part that people need to understand on the down payment and closing cost assistance. Again, great program. It's there to get you into homes. Okay, I'm not saying it's not a great program because it most certainly is.
Yeah, yeah.
But on the example we just used,
Mhm.
you are purchasing a home at 250,000. Okay,
Mhm.
your 3.5% down payment. So your first mortgage then is going to be roughly about what, 242 or 241. Okay,
Yes.
because we're going to use some of that $15,000 to get the required down payment. So you're going to start your mortgage at about 251.
Okay.
But you have that down payment of 15,100 on top of it.
Yeah.
Down payment and closing. So when you close on a home loan at the example of 250, now you owe on that property right at 256,000.
Mhm. And
Well, maybe 255. I didn't do my math right there, right? Yeah. So you owe more than what you bought the house for.
okay, more than what I bought it for, and maybe even I owe more than what it's appraised at.
Could potentially, yes.
Potentially?
And that's what people need to understand
Okay.
is if it comes in and the appraisal is at 250, which is perfectly fine,
Mhm.
you're gonna owe more than what the appraised value is. Again, nothing wrong with that if that's what's needed to get you into a home. But you've got to make sure and pay attention that when rates are higher, people want to refinance, and they should, when rates go down. But knowing your numbers is gonna help you know, okay, if the homes are appreciating still,
Mhm.
and they are,
They are.
at what rate potentially are they? And when can I probably then refinance? Because to refinance, you've got to have equity in your home.
Yeah.
The loan type on a refinance will determine how much equity. And we're not trying to explain this to scare people.
No. Yeah.
It's an absolute wonderful program
Mhm.
and it's absolutely used.
I think it just goes back to true transparency, which was one
Knowing
of our
what we're
programs
talking
that we
about.
did. True transparency. No,
Right.
you be the expert, right?
Understanding it.
Mhm.
And if you have questions, we are here to guide you through, even if we're not doing your home loan.
Yeah.
But you need to understand all the aspects of getting any type of down payment and closing cost assistance.
Yes. Yes.
Okay?
And so am I required, okay, so how much can I, so we were explaining this and I'm just gonna take you back a little bit. There is, so let's say I have to come in with this $15,000, that I'm not getting any help for, I have, this is the amount of my closing costs and my down payment. But I do have a little bit, let's say I have 5,000, do I have to use, is there a percentage of how much I can be given in assistance?
Honestly, that's really great, because no, you don't have to use the full amount.
Okay,
Okay, so obviously then, even if you don't use the full amount, however, the interest rate on your first mortgage goes to the example we gave, 7%.
okay,
And then the interest rate is on your second mortgage, no matter what that amount is still 2 points above. So in the example, it's 9%,
okay,
is still termed for 15 years. So instead of 15,000, you want to use the 10,000. If you had five,
mhm,
right? The
Yep.
example you gave.
yeah,
You want to use the 10,000, then you're still going to have a slightly higher interest rate on your first, and that down payment assistance program is still going to calculate the same.
Okay.
But your equity position is going to be better.
better,
So
Okay.
when the time comes that you can refinance and the rates potentially get lower, because anybody saying they will, I do believe they will.
Yeah.
When, we don't know.
Mhm.
But you've got to know your facts, at least then your equities position is going to have a better chance of getting that refinance done when the rates do go down.
when they go down.
Yes.
Yeah, that's
And
great.
even if you had 10,000, same concept.
Mhm.
Of that 15,000, if you had 10,000, we only needed to borrow 5, great. Then you're still in a better equity position,
Mhm.
okay? And that's really what I wanted to explain, that we know that we coach our clients on, and we
Mhm.
need it out there.
Yeah.
To understand what that loan really looks like.
Yeah, I mean, as you said, it has to make sense to you. It has to feel right to you. And as Debbie said, they are phenomenal programs. They're wonderful programs that have helped millions and millions of home buyers get into homes. So,
It's a great program, and as prices keep to appreciate, it will. Let's say it's even 2 years down the road,
Yeah.
you're going to be in a great position. No, there is no better, and I don't mean to get off on a tangent on this, wealth builder.
Yeah.
Than equity in your own home.
Equity in your own home. And even
So-
if you start under
Or slightly, or
or
whatever,
slightly under,
you're still gonna
or
build.
right there, you're still building, yeah.
Yeah.
And you're in your own home,
Right,
so,
yeah,
Okay.
so that's one program.
that's one, okay.
Yeah.
And so then I recently, well, we've had this experience and we've had these talks, especially when rates started climbing back up. We we dove back into what we consider and this is a different loan program that we can look into, and this is what an assumable mortgage.
Okay,
So,
right, and we've got actually, I can tell you in the last 2 weeks, 5 going on right now.
Mhm.
Okay, so I'm gonna clarify what this all means.
Mhm.
Because an assumable mortgage, so what happens is if a seller of a home has a FHA or a VA loan, those are government-backed loans. And those are assumable. In other words, if they want to market their home, that you just take over my current interest rate loan, you can do that.
so I
Okay.
take over your current rate, and do I take over what you currently owe, or am I gonna take
Right.
over what you owe plus what it's worth now? Or what it's worth?
So how that works is you're gonna take over that mortgage. You still have to qualify for it. And so what I tell anybody that wants to look at assumable, and again, we've got several of them out there.
Mhm.
This really comes to the seller of the home calling their current servicer. Okay, they've got to call their servicer and say, do I have an assumable loan?
Mhm.
If the answer is yes, and let's say the example is they have an FHA assumable loan and the rate's 3%. Okay,
Okay.
now FHA, we already know, has private mortgage insurance on it.
Yes,
That can't go away. It's
correct.
on the loan. But I'm gonna tell you right now, when you do the numbers, you will not find a better loan, even if you're going conventional, wanting to put 20% down. It's today's rates. And in fact, that's the exact example of what I talked to a client about just last week. Okay, but here's how that works.
Mhm.
Is the owner has to call their servicer, in other words, who they write their mortgage check to. Okay, at Guild, it'll be Guild. Some places sell them, it doesn't matter. Call the servicer of your loan, make sure you're assumable. And let's say, okay, let's just use 250 again as an example, just
Okay.
because I've got that in my head. But let's say they wanted to list their house at 300 or 350. Okay, so if they owe 250 on the home and they list at 350,
Mhm.
the new buyer does have to come in with the difference.
Okay,
Okay,
okay.
so there's that right there.
They have
Know
to
that
come in
it-
with the difference and qualify for 350 rather than 250.
No, they would qualify to take over the buyer's payment of 250.
Oh, okay, qualify to take over the payment of 250.
Right.
Okay, that's important to know.
Right.
And then have that extra 100.
They have to have that extra to put it down.
Okay,
And believe it or not, we're seeing quite a bit of that. We really honestly are. People have saved up thinking, we gotta have 20% down, whatever the reason.
Mhm.
We are seeing quite a bit of that money is there. And so if it's 350, then it's 100,000 they have to come in with.
Mhm.
Plus they have closing costs.
yes.
Okay, so
Okay,
you've
the
got
fees.
closing costs.
Mhm. How much what's the difference in the
Standard
fees?
closing costs.
Okay.
Standard closing costs.
Okay,
The servicer of the loan will be determined if a new appraisal is needed or not.
okay,
Okay, so the new buyer also has to talk to the servicer. A loan officer cannot do the assumable loan. Okay, you have to get through the servicing department. At Guild, I can help guide you and help you understand it, and I can help articulate what's going on for you,
Mhm.
for sure.
yes,
I can't speak for everyone on that.
yes.
They're not scary, but the new buyer has to qualify.
Mhm.
So they've got to make sure that they have the difference to make up.
Mhm.
And honestly, on the example that I did just last week, and like I said, we've got 5 of them. They're people that Guild has the mortgage on, and they're wanting to sell. And we've got 5 of them going on right now that I am perfectly aware of. There could be more, I don't know.
Yeah.
And on the prime example that I just did last week for somebody, They did have, the borrower could easily be qualified, 20% down, everything golden, and they found a property that has an FHA loan at 3%, even with that private mortgage insurance factored in
Mhm.
on this particular borrower.
Mhm.
The current FHA loan, even if he had taken the exact same amount of money, so this borrower had that exact same amount of money to put towards a different home,
Uh-huh.
his payment using that current owner's FHA was $600 and some cheaper using the FHA mortgage than it would be if he had gone and got a conventional loan at today's current rate, putting all that same amount of money down.
Oh,
He
that's
saved almost $700.
That's a lot.
That's a ton of
That's-
money.
yeah,
And
that's
that's
a
one
lot.
thing I explained to that new buyer, as I said, and I showed him in black and white, your better loan is gonna be that FHA loan, even with that private mortgage insurance premium on it.
That's huge.
It is,
So
it's a
it's
huge
huge.
savings.
So if I'm somebody looking, okay, let's, what loans then, just to go back up and explain, what loans then are assumable? What loans, programs? So if somebody has a conventional loan, or what loan
Okay.
programs can I look at assuming?
It's going to be your government loans.
Okay.
Which is going to be your FHA and your VA
Okay,
and your RD.
okay,
Okay, but
RD.
RD still has to fit into that income category.
okay.
Okay,
And
so
RD
those-
is also USDA, right? Like
Correct. That's
you've
your
heard the term USDA loan? Okay,
Correct. So your
okay.
government loans are all by definition, and it's on a note, assumable.
Okay,
Okay? That does not mean the servicer has to partake in that. Okay? So that's why the owner of that property
Okay.
needs to contact their servicer to make sure it's an assumable loan.
Okay, okay, that's where you said that call needs to be made.
Yes,
Okay.
before they even say, yes, we can assume the loan.
Okay,
Okay? Typically, when you're assuming the loan, it can take maybe a little bit longer. And I'm just saying this just because right now I know personally our own assumption department is absolutely crazy busy.
Mhm.
So it can take longer.
Yeah.
Unfortunately, I've talked to agents that have said that they've got listings, and unfortunately, some of these other companies are saying 6 months out even to do an assumable loan.
Oh, wow.
And I'm sorry, you can't do anything about that
Yeah.
if it is a company that is gonna take a while to assume the loan. So just be aware, that's why it's gotta start with the homeowner.
Mhm.
And then what happens that as soon as there's a contract written, then that homeowner needs to provide to the servicing company, in other words, Guild,
Hmm.
or whomever that is, the contract for the purchase.
Okay.
They need to give the servicer the contact information for the new home buyer, because the servicing department then will reach out to whoever that new home buyer is going to be
Okay.
and get the ball rolling, get the application, get things done to make sure they qualify to take that over.
Okay.
So,
And if okay, so let's say I've got the home and I've called and they said, yes, you're in the loan program that you potentially be an assumable loan. If I'm gonna sell it, do I need to make sure that, that my home loan payments are on time, have been on time?
oh,
Do they,
absolutely.
are they gonna
Yeah.
verify that?
Yeah.
Okay, because if they haven't been made on time, then I'm not, my home or my mortgage is not gonna qualify potentially
No,
for that?
not necessarily.
Okay,
No, not necessarily.
Okay.
And I'm gonna back up because I didn't answer the one question on a conventional loan.
okay,
Okay, so you'd asked the question on
Yes.
what loans.
Mhm.
Conventional loans are typically, again, this is on the note, only assumable to potentially a family member
okay,
or potentially an ex-spouse,
okay, potentially, you
Okay.
say potentially,
potentially.
okay,
Again, if that is the situation, the owner that wants to come off record and sell the house or quit, do something with that,
Mhm.
needs to call the servicing department
Mhm.
of who owns theirs to see if on a conventional loan, that loan could be assumable under what circumstances.
okay,
Okay, because conventional by definition is not an assumable loan.
okay, okay.
Okay.
So that's another thing,
Mhm.
but potentially could or could not work on a conventional.
Right.
To a family member.
Right.
Okay.
Right.
Okay.
But those are two really good loan
Yeah.
types, especially those assumable loan. If you're finding somebody with that and you do have that money,
Mhm.
and we gave a big difference between 350 to 250, but sometimes it's not that big a difference.
Yeah.
It's great. Honestly,
Right.
if somebody's sitting currently on such a good interest rate loan and a VA loan, okay, we touch base on the VA
Okay.
being assumable.
Yeah,
I'm jumping back, so forgive me. You do not have to be a veteran to assume a veteran's loan.
that is huge, because
It
people
is
assume
huge.
you have to be a veteran to be able to assume a VA.
Correct.
Yeah.
Correct. Now, there are some parameters on if you're not a veteran, assuming a veteran's loan, that the current veteran would need to understand and make sure it was okay to still assume that loan.
Okay.
Okay, so there are those parameters and we can talk further on that if you guys just wanna reach out to us, DM us, whatever.
Yeah.
So, yeah, but great, a couple great programs that we just want you to have some clarity on and know that they're out there.
Yeah, know that they're out there. Definitely reach out to us if you have any questions.
Yeah.
Even if you have your loan going with through somebody else, or you have somebody else that you've spoken with, we're
Yeah.
just here to answer your
Help
questions.
answer questions.
Yeah.